with that perspective. Thanks indeed. Our Alpha Manager of the day is with us. Harish Krishnan is joining us. He's Executive Vice President and Senior Equity Fund Manager at Kotak Mahindra Asset Management Company. Harish, good to have you with us here. Thank you very much. You know, you run the Balanced Advantage scheme as well, fund as well at Kotak. What is the equity exposure in that now?
Right, Prashant. So yes, as far as our asset allocation product is concerned, the Kotak Balanced Advantage Fund, currently we are at about 45% in net equity. Just to provide a broader perspective as to where we moved over the course of the last few years, we varied from about 20% to 80%. The same time, around September of last year, we were at 31% invested in equities. Sometime in May of this year, we taken it up to 54%. And in the last 4-5 months, given the strong comeback in equities, we've toned down our exposure from 54% to about 45%. So that's been the broad range of equities as we speak now.
And when was, you said 20 was the lower bound. When was 20? When?
Right. So that was sometime in 2018 when we were at about 25%.
Okay.
So, yeah.
20, okay, all right, fair enough. Now, I was reading an article where I think it referenced S. Narain of ICICI Pru, and now in the Balanced Advantage Fund Balance scheme that they run, they're at 10-year lows in terms of equity exposure. So just thought I should ask you that. I mean, your exposure goes up from here if the market keeps going higher or lower?
No, so we are a counter-cyclical balanced advantage fund as well. So like I said, last year we were at about 30% in September of 2021, when there was, gay abandon and everybody was talking up on equity markets and there was a lot of froth. And as markets corrected, we increased our exposure to 54%. Currently, I mean, if I were to contextualize how we positioned now compared to how it was, say, 18,000 levels last year and what the key differences are, clearly valuations is one factor that we consider, which is moderated a bit. Yes, on a standalone basis, still India is trading at elevated multiples from a 20-25 year kind of a history, and it still stands up even more, when we look at on a relative context, where across the world markets are significantly more cheaper compared to where India is. But it's on the other parameters that I think a lot of froth has gone away from. So if you look at, say, for example, the breadth of the overall market, or if you look at the number of stocks making lifetime highs, or the number of huge divergence that we'd seen in small and micro caps over large caps, they were at almost record highs in 2021 second half. That has moderated quite substantially as we speak now. So therefore, a lot of froth as far as sentiment has kind of dwindled down. But having said that, clearly valuations are punchy, which means that therefore we are below the neutral recommendation for equities, and therefore, which is why we are currently at about 45% in equities.
Got that. Well explained. Harish, revenge consumption in stocks like retail, travel, auto, entertainment all skyrocketed in 2020. But it was partly boosted on account of the COVID-related savings that people had of 2020 as well as 2021. But now that savings has actually been spent in 2022, and now inflation has started to pinch. So do you not get the sense that consumption of these, in these sectors like auto or retail, travel, is going to slow down in 2023?
So if you look at consumption, there are the two buckets, right? You've got the bottom of pyramid consumption and the, you can say, aspirational urban-led consumption or consumer discretionary. We are a lot more circumspect on the bottom of the pyramid consumption, primarily because of the fact that in our assessment, COVID has definitely impacted the income profile and the savings profiles of the bottom of the pyramid quite significantly. And therefore, there is a impact in terms of their overall consumption trends. Your point is well taken that there has been a significant base effect, the fact that revenge consumption came out in full swing in the whole of 2022, where we didn't have any of those issues. But when we look at the year ahead, I think it's also important to understand that there is, especially in urban India, there has been reasonable amount of hiring on the formal side, be it in terms of the IT sector or be it in terms of other services sector. Manufacturing is doing quite well. Real estate so far has picked up quite well. So the overall wealth effect continues to remain reasonably buoyant. There is a new addition of employment pool into the formal workforce in urban India. So I think it's a confluence of all of these that makes us slightly more positive on consumer discretionary, especially which are more focused towards urban India compared to the bottom of pyramid consumption. But yes, the big move in terms of the revenge consumption clearly is not going to come through, in the future.
Okay, all right. Hi, Harish. Good afternoon. Nigel on this side. Well, how do you play these consumer discretionary plays then? There's auto in there. There could be retail in there. Real estate, you've already mentioned. You're fairly positive out there. So which are the themes you're looking at playing?
Right. So the way we look at it, Nigel, is that over, say, a 20-year period, I'm just giving you an example. For example, auto sector. Auto sector profit pools have varied from 0.5% to 10% of total profits. And currently we are close to about, say, 2.5%, 3%. So if you look at consumer discretionary categories like auto, real estate, media, retailing, a lot of these consumer discretionary are actually significantly below in terms of their profit pool contribution to the overall profits. And we think that, therefore, those are the areas where we still have reasonable exposure. But yes, we were a lot more positive getting into 2022 with a significant move in many of these names. We have pared down some exposure in those names, but we continue to have an overweight stance on many of these sectors, including real estate, including auto, including retailing plays, as well as in terms of travel.
The number for real estate as a profits as a percentage of total right now, Harish? Sorry.
Yeah. Right. So real estate is a very small sector, Prashant. Both in terms of profits as well as in terms of sales. It's generally been about, and as you would be aware, bulk of real estate sector stocks got listed only post 2007. So in that small time frame, we've got a very limited window, but it's been a very small percentage, less than about 2% of overall profits. That's been the range that they've been there. And, it's pretty much there.
Harish, if you have to further bring down your equity exposure in your fund, which is the sectors you would look to exit out of in your portfolio?
Right. So I think incrementally we are getting a bit worried on banking in the sense that we have had the best of everything that's played out in terms of banking. They've had very good credit growth. There's been expansion in NIMs. There's been buoyancy in fee income. And best of all, there have been pretty much very low credit cost that have come through. So it's been a crescent of a whole bunch of variables that have kind of helped the banking space. And banking stocks have done quite well. And therefore, I think at the margin, we would be looking to pare down some of our exposure out there, even though, in the bigger scheme of things, we continue to have a reasonably large weight out there. The other sector that we continue to remain watchful of is, like I said, on the consumer side, especially on the bottom of the pyramid, our exposure over there, we'll further calibrate, or we're looking to further calibrate down as we speak. And that's the other space that we would be watchful of. Conversely, where we are looking to increase exposure would be in sectors which are consumers of energy. So be it gas, be it tiles, building products, building materials. Those are the areas which got significantly impacted during the energy crisis of last year. And we do think that, consumers of energy will get some benefit as we go through in the next year. And that's the space that we're looking to increase. Similarly, IT is another space which got the rough end in 2022, and we're cutting down our underweights over there marginally as we speak. So that's broadly where the incremental kind of pulls and pressures have been as far as the portfolio is concerned.
Okay, all right, Harish, from the banking and financial space, which is a consensus theme, and you're sounding that how much of it, the good news are already in the price. If you were to scale down exposure out there, which part will it be? You have exposure to private banks. You had exposure to a PSU bank like SBI, at least, is what your fund details were showing at least a couple of months ago. And also you had NBFCs, the largest ones, Bajaj Finance and the likes. Right. So which segment would you be looking to taper down exposure?
So, at the margin, I think whichever have done very well is where we would like to lighten up positions on. It's primarily been some amount of exposure which has done exceedingly well in terms of state-owned banks, especially in the last 3 months, where we've seen a significant rally in smaller state-owned banks. So that's one area where we would want to calibrate down our exposure. Similarly, if you were to look at some of the larger, well-run private sector banks, which have had a phenomenal run over the course of the last 4 or 5 years, that's again an area where we would want to tone down our exposure. Again, it doesn't mean that we are exiting or we are completely going underweight. It is some form of profit booking that we are taking down to reduce our overweights in that overall space that we are there. On NBFCs, we don't have too much of an exposure. We've been a bit more circumspect, and therefore we would be maintaining that stance out there as far as NBFCs is concerned. The area which hasn't actually worked out is on the insurance place. That's a space where we have some exposure, and over there, currently we are not really changing our stance as far as those holdings are concerned.
All right, waiting in on insurance. Thanks very much, Harish. It's always a pleasure. Thank you very much for joining us here on Closing Bell on CNBC.